Welcome. Let's be honest. Have you ever looked at the stock market and it just feels like, well, a complete mess of flashing numbers and crazy reactions? Today, we're going to change that. We're putting on our detective hats, and we're going to treat valuing a company like a thrilling investigation to find out what it's really worth. Let's get into it.
And this right here, this is the central mystery every single investor has to solve. You see that price on the screen, but is that the actual value of the company, or is it just what's popular today? This is the exact case that fundamental analysis was designed to crack.
You can think of it like this. We've got two main suspects. Over here, we have the market price. It's loud, it's emotional, and frankly, it changes its story every time a new headline drops. And over here, we have intrinsic value. This is the quiet, calm, fact-based reality of the business itself. Our mission as detectives is to tune out all that noise and find that true intrinsic value.
So let's officially begin our investigation. We're going to start with the mystery of true value and get familiar with our toolkit, which is fundamental analysis. This is how we're going to systematically dig through all the clues to figure out what a business is genuinely worth.
Okay, so this is our official mandate. But what does it really mean? Look, it's not about trying to predict the stock's little wiggles day to day. It's about being a business analyst. We have to examine the whole picture, the economy, the industry, the company's financial health, to build a solid, evidence-based case for its value.
Right. No detective worth their salt just rushes in and starts interrogating people. First, you have to survey the scene of the crime. For us, that means getting a handle on the broad economic environment because the economy sets the stage for every single company we're going to look at.
And the single most important force at our crime scene, it's gravity. Or in our world, it's interest rates. As the legend Warren Buffett put it, they literally pull on the value of everything. Think about it. When rates are low, future money is worth more today, so valuations go up. When rates are high, well, the opposite happens. It's the absolute starting point for any investigation.
So what does our scene look like right now as you look ahead? The clues are pointing to a really complex mix. You've got government spending still flowing in, you've got interest rates that are expected to calm down a bit, and of course you have this massive technological tidal wave with AI. Each one of these clues is going to have a direct impact on company profits and therefore their value.
Now here's a key piece of evidence some forecasters have put together. They're pointing to a potential S&P 500 target somewhere around 7,800. What does that tell us? It suggests a backdrop of general optimism, a kind of favorable wind at our backs as we start this investigation.
And check this out, another crucial clue, this time from fiscal policy. A proposed tax cut could pump $129 billion back into businesses. Now, this isn't just some abstract number, okay? This is actual cash that directly boosts profits and free cash flow, which makes it a critical piece of evidence for any valuation we do.
All right, we've surveyed the wider scene. Now it's time to zoom in and focus on our suspect, the company itself. And the very first question any good detective asks is, how does this business protect itself? In the world of investing, we call that defense its economic moat.
Buffett actually came up with the term, and the analogy is just perfect. A fantastic business is like a castle, and its competitive advantage is the big, wide moat that keeps all the rivals from attacking. A wide, sustainable moat is probably the #1 qualitative clue we're searching for.
So, where do these moats actually come from? Well, as detectives, we're on the lookout for 5 main sources. First, you've got intangible assets. Think of a super powerful brand or a crucial patent. Second, high switching costs, when it's just a huge pain for your customers to leave you. Third is the network effect, where a service gets more valuable the more people use it. Fourth, a deep cost advantage, which lets a company totally undercut its rivals. And finally, efficient scale, which happens when a market is just too small to really support more than 1 or 2 big players.
Okay, so we've sized up the company's defenses. Now it's time to get our hands dirty and look at the hard evidence. We need to follow the money, and that trail is always found in a company's financial statements. This is the forensic part of our investigation.
And there are 3 key documents in the evidence locker we need to look at. Think of the income statement as the movie of the company's year. It shows all the sales and profits. The balance sheet, that's just a single photo, a snapshot in time of everything it owns and owes. But honestly, the most important one is the cash flow statement. It's like getting a peek at the company's actual bank records to see where the cash really moved.
After all that digging through the statements, all of our forensic work really leads to one number that matters more than anything else: free cash flow. It's the cash a company makes just from its operations, minus the money it has to spend to maintain and grow the business. It's the real spendable profit that's left over for the owners. It is the lifeblood of the company and the ultimate source of its value. Period.
So, let's recap. We've surveyed the scene, we've analyzed our suspects' defenses, and we've followed the money trail. Now it's time for the final act, putting all these clues together, building our case, and coming to a final verdict on the company's true value.
And there are two main ways that we do this. First is the discounted cash flow, or DCF. That's kind of like the scientist's method. It tries to calculate exactly what a company should be worth based on all the cash it's going to generate in the future. The other way is comparable analysis. You can think of this as the realtor's method. You just look at what similar houses or companies in the neighborhood are selling for right now. Now, I know the DCF method looks a little intimidating, but trust me, it's really just a logical four-step investigation. Step 1, you forecast the company's free cash flows for the next 5 or 10 years. Step 2, you estimate its value for all the years after that. Step 3, and this is the really key part, you take all that future money and discount it back to what it's worth today. And finally, Step 4, you just add it all up. That sum is your verdict on the company's intrinsic value. And that right there is the whole point of our investigation. It's to arrive at an investment thesis, a clear, rational, data-driven story of what you believe a company is worth and why. This thesis becomes your anchor, the thing that keeps you calm and making smart decisions when the seas of the market get rough and stormy.
So you see, valuing a company really isn't about magic, and it's definitely not about luck. It's about methodical detective work. It's about gathering clues from the economy, from the business itself, and from the financials to build an undeniable case. The only question left is, what case are you going to crack open first?